Hello everyone, this is Jennifer. So we're going to start with the continuation of the ratio analysis problem. So our next problem is, following is a balance sheet of Nishant Limited as at 31st March 2016. They have given the liabilities and assets, and they have given additional information telling sales during the year is rupees 8 lakhs, cost of goods sold is 6 lakhs, office and administrative expenses is 1,12,000, commission and discount earned is 12,000, loss on sale of machinery is 34,000, profit on sale of building is 54,000. And after that they have told us to calculate certain ratios like the current ratio, liquid ratio, stock turnover ratio, gross profit ratio, operating cost ratio, net profit ratio, debt equity ratio, solvency ratio, proprietary ratio, and fixed assets to net worth ratio. So we'll start with our first ratio that they've told us to calculate, current ratio. So the current ratio formula is current assets divided by current liabilities. So what are your current assets? So if you look into the question, current assets are debtors, which is 2 lakhs, bank and cash, which is 90,000, prepaid expenses 10,000. So total it comes to 3 lakhs. So 3 lakhs plus, and the closing stock also is 3 lakhs. So 3 lakh, 4, 5 lakh and 6 lakhs. The total of current asset is 6 lakhs divided by current liability. So if you look into the liability side of your balance sheet, current liability they have given 4 lakhs. So take as it is. So current liability is 4 lakhs. So current assets divided by current liability, 6 lakhs divided by 4 lakhs, 1.5 divided by 1. So the ratio is 1.5 is to 1. So next they have told us to calculate liquid ratio. So the formula is liquid assets divided by liquid liability. So liquid assets, in liquid assets you will not include the closing stock, which is 3 lakhs. So if you minus 3 lakhs, you will, the other liquid asset that you have in the question is debtors, bank and cash and prepaid expenses. So 2 lakhs 90,000 plus 10,000 divided by the current liability, which is 4 lakhs. So your ratio is 3 lakhs by 4 lakhs, 3 lakhs by 4 lakhs, which is equal to 0.75 is to 1. Next, they have told us to calculate stock turnover ratio. The formula to calculate stock turnover ratio is cost of goods sold divided by average inventory. So here we do not have average inventory, here we have the closing stock. So the formula you can implement is cost of goods sold divided by closing stock. So cost of goods sold, which they have given in the additional information as 6 lakhs, divided by the closing stock, which is 3 lakhs. So the ratio is 2 times. Next, gross profit ratio. The gross profit ratio formula is gross profit divided by net sales into 100. So gross profit is nothing but sales minus cost of goods sold. So sales is 8 lakhs, cost of goods sold is 6 lakhs divided by 8 lakhs into 100, which is 25%. Next, operating cost ratio. Operating cost divided by the net sales into 100 as a formula. So what all operating costs we have in the question is cost of goods sold and the office and administrative expenses. Cost of goods sold is 6 lakhs, office and administrative expense 1,12,000. So total it comes up to 7,12,000. So 7,12,000 divided by 8 lakhs into 100, which is equal to 89%. These all are profitability ratios, so you're multiplying it into 100. Next is net profit ratio. Net profit divided by net sales into 100. So net profit, we do not have net profit directly given in the question, so we are supposed to calculate the net profit. For the calculation of net profit is equal to gross profit plus all the incomes minus all the expenses. So profit on sale of building plus commission minus office expenses and loss and sale of machinery. So you get 2 lakhs plus 54,000 plus 12,000 minus 1,12,000 plus 34,000 divided by net sales they have given in the question, which is 8 lakhs into 100. Therefore, it is 1,20,000 divided by 8 lakhs into 1,20,000 divided by 8 lakhs into 100, which is 15%. Next ratio they have told us to calculate is debt equity ratio. So outsiders fund divided by owners fund. Outsiders fund are nothing but that you are supposed to liable to pay them. The owners funds are your equity share capital, preference share capital, reserves and surplus. So outsiders fund is 6 lakhs plus 4 lakhs divided by owners fund is nothing but equity share capital, which is 5 lakhs plus preference share capital 4 lakhs and reserves and surplus, which is 4 lakhs. So therefore you have 10 lakhs divided by 13 lakhs, which is equal to 0.77:1. Next is your proprietary ratio. Proprietary ratio formula is shareholders funds divided by total assets into 100. So shareholders fund is 13 lakhs. So which is equal to 5 plus 4 plus 4, which is equity share capital plus preference share capital plus reserves and surplus, divided by total assets, the asset column. If you see the asset side of the balance sheet, the total is the 23 lakhs. So if you take that into 100, which is 56.52%. Next is fixed assets to net worth ratio, which is equal to fixed assets divided by shareholders fund into 100. So fixed assets in the question we have land and building, which is 9 lakhs, plant and machinery 8 lakhs, divided by shareholders fund is 13 lakhs into 100. 17 lakhs divided by 13 lakhs into 100, which is 130.76. Next is solvency ratio, which is current assets. The solvency ratio in the question, according to the question, we can only do two ratios under solvency, which is current assets to proprietary fund ratio, which is equal to current assets divided by shareholders fund into 100. Current asset we have 6 lakhs divided by shareholders funds we have 13 lakhs into 100, which is 46.15%. Capital gearing ratio in the question we have preference share capital and the long term borrowings divided by the equity share capital plus reserves and surplus. So 10 lakhs divided by 9 lakhs, it is 1.11:1. Our next question, you are furnished the following information from the books of TSL Marketing Limited for the year ended 31st/3/2016. Equity share capital they have given, preference share capital they have given, and they have given profit after tax at 60%, depreciation, equity dividend paid, resources, market price per equity share, and they have told us to calculate dividend yield ratio, preference dividend ratio, equity per share ratio, dividend payment ratio, price earning ratio. So the first one is calculation of dividend yield ratio. So dividend yield, dividend per share divided by the market price per share into 100, which is equal to, if you see in the question they have told market price is 40 rupees. So dividend per share, equity dividend paid is 20% they have told. So 20% into 10 rupees. The face value of share is 10 rupees. So 20% into 10 divided by market price is 40 into 100, which is equal to 5%. So dividend yield is 5%. Next is calculation of preference dividend ratio. Preference dividend ratio is profit after tax divided by amount of preference dividend. So profit after tax, which they have given in the question to be 2,70,000 divided by amount of preference dividend is amount of preference dividend is 27,000. So how did you get this 27,000? Is 3 lakhs is your preference shares. So 3 lakhs is your preference shares into 9%, which is 27,000. So 3 lakhs into 9% is 27,000. So 2,70,000 divided by 27,000. 27,000, which is 10 times. Calculation of earnings per share EPS. The formula is earnings available to equity shareholders divided by number of equity shareholder. So earnings available to equity shareholders is 2,43,000. How did you get this is profit after tax is 2,70,000 minus your amount of preference dividend, which is 27,000, which is equal to 2,43,000. So earnings available, which is equity shareholders, is profit after tax less preference dividend. So 2,70,000 minus 27,000, which is 2,43,000, which is equal to 3.04. Next is calculation of price earning ratio. The price earning ratio formula is market price per share divided by EPS. So 40 rupees is your market price divided by EPS is 3.04, which we calculated, which is equal to 13.16 times. Next is calculation of dividend payout ratio, which is dividend per share divided by EPS. So 2 divided by 3.04, which is equal to 0.66. So dividend per share, how did you get is 1,60,000 divided by 80,000, which is equal to 2. How did you get this 1,60,000 is 8 lakhs, which is the equity share capital, into 20% of dividend. So 1,60,000 divided by how many shares we have? 80,000 shares, is equal to rupees 2. So EPS is 3.04, which you already calculated. Moving on to the next question. Using the following data, complete the balance sheet. Gross profit 20% of sales, which is 60,000, and they have given other information, and they have told us to complete the balance sheet. To complete the balance sheet, we need share capital, long-term debt, creditors, fixed assets, stock, debtors, cash, etc. So we need to calculate each and everything. This is a kind of indirect question wherein you're supposed to calculate with the given information using the different formulas. So let's calculate one by one. So we'll start with calculation of sales. So in the question, if you see, they have given gross profit is 20% of sales, which is 60,000. So let sales be X, gross profit is equal to 20% of X. So 20X divided by 100. So which is equal to X divided by 5. 1s are 5s are, so X divided by 5. So 60,000 is equal to X by 5. So what is X? 3 lakhs when you cross multiply. So sales is equal to 3 lakhs. Calculation of total assets. So with the information provided, we have the sales. Now total assets turnover ratio is equal to sales divided by total assets. We have sales, we have the total assets turnover ratio given in the question, which is 3 times. So which is equal to, when you cross multiply, you get total assets to be 1 lakhs. So keeping up your total assets, we can find out other things also. Now let us calculate the closing. Now what is the next information they have given? Closing stock turnover ratio, which is 8 times. Using this, let us calculate the closing stock. So closing stock turnover ratio is equal to cost of goods sold divided by closing stock, which is the same formula as stock turnover ratio. So 8 they have given. So sales minus profit is your cost of goods sold divided by closing stock. So 8 is equal to 3 lakhs minus 60,000. So 3 lakhs is sales minus 60,000, which is gross profit, divided by closing stock. So closing stock is equal to 2,40,000 divided by 8. Closing stock is equal to 30,000. Now calculation of debtors. So what is the information they have given in the question? Average collection period for 360 days is 18 days. So average collection period formula is number of days in a year divided by credit sales into debtors. So average collection period they have given in the question to be 318, which is equal to number of days in a year they have given in the question to be 360 days, divided by credit sales. In the question they have given it as 2,40,000. So credit sale is to total sales is 80%. So total sales is 3 lakhs. So credit sales is 80%, which is 2,40,000 into debtors. So when you cross multiply, we get 360 debtors is equal to 443,20,000. So debtors is 12,000. So calculation of current assets, current ratio is equal to current asset divided by current liabilities. 1.6 is equal to current assets divided by 30,000 is your current liability. Cross multiply current assets, we get it as 48,000. Now if you go back to your balance sheet, share capital is 50,000, which they have given in the question itself. Share capital as 50,000. So if you see in the question itself, they have given share capital is 15,000. Long term debts is equal to 20,000. How did you get this 20,000 is? So long term debt, they have told in the question, it is 40% of equity. So equity we have 50,000. 50,000 of 40% is 20,000. Next, fixed assets. So let us look into stock. Stock is 30,000, which is our closing stock, which we found out. Debtors is 12,000, again we found out. Cash is, so if you see the current assets, we have got it as 48,000. In that we have stock 30,000, we have debtors 12,000. So the remaining is cash, we consider it to be 6,000. So and also we got another information from our working note, which is total asset is 1 lakh. So balancing figure will be 52,000, which is fixed assets. If your asset side is 1 lakh, your liability side also needs to be 1 lakh. So creditors will be your balancing figure, which is 30,000. Moving on to the next question, they have given different ratios and they have told us to draw a balance sheet. So to draw a balance sheet, you require necessary information like your capital, reserves, current liabilities, fixed assets and current assets. So depending on what information they have given, we can start finding out each thing. So moving on to first thing that they have given information about. So first let's start with calculation of current assets. Since we have current ratio given in the question 2.5, so let's start with finding out the current assets and current liabilities. So calculation of current assets, working capital is equal to current assets minus current liabilities. Why we are using it? Because we are having the working capital given, net working capital, which is 3 lakhs. Using that we can use this formula. So current asset working capital is 3 lakhs is equal to 2.5 minus 1. Okay, because that the ratio 2.5 is to 1 is a ratio, so 2.5 minus 1 is equal to 3 lakhs. So current asset is equal to 3 lakhs divided by 1.5 into 2.5. So just cross multiplying. So 3 lakhs into 2.5 divided by 1.5. How did you get this 1.5 is 2.5 minus 1. So current asset is 5 lakhs. So current liabilities in the same way, 3 lakhs divided by 1.5 into 1, which is equal to 2 lakhs. So moving on to stock, calculation of stock. Stock is equal to current assets minus quick assets. Quick asset can be computed with the help of quick ratio. Quick ratio is given in the question, which is 1.5. So quick assets divided by current liabilities is the formula. So quick asset is equal to 2 lakhs into 1.5, which is equal to 3 lakhs. So cross multiplying. So stock is 5 lakhs minus 3 lakhs, which is 2 lakhs. Calculation of fixed assets. Fixed assets can be computed with the help of sales, which is not specifically given in the problem. So sales can be found out through the stock turnover ratio. So stock turnover ratio formula we know, which is cost of goods sold divided by average stock. So 6 is your stock turnover ratio, which is they have given in the question. So cost of goods sold we do not know. So 2 lakhs is our average stock, which they have given in the question, which we found out. The closing stock is 2 lakhs, so we'll use that only, stock. So cross multiply, cost of goods sold is equal to 2 lakhs into 6, which is 12 lakhs. Sales is equal to cost of goods sold plus gross profit. So gross profit ratio is given on sales as 20%, but when it is calculated on cost, it will be computed as follows. Assume sales to be 100, so let the profit be 20%. So 100 plus 20, which is 100 minus 20, which is 80, is nothing but your cost. Why? Because sales price is more than your cost price. Okay, that's why we are having a profit. So gross profit percentage on sales is 20 divided by 80 into 100, which is 25%. So profit divided by cost into sales into percentage, which is 25%. So gross profit is equal to 12 lakhs into 25%. So sales is 12 lakhs, so into 25%, which is 3 lakhs. Sales is equal to cost of goods sold plus gross profit. So sales is equal to 12 lakhs plus 3 lakhs. So sales is 15 lakhs. Fixed asset turnover ratio. Now with the help of net sales, we can calculate the fixed assets because we have the turnover ratio given in the question. 2 is a ratio which is equal to 15 lakhs divided by fixed assets. So now fixed asset amount is 7,50,000. Now calculation of debtors. So debtors can be ascertained with the help of debt collection period. So debt collection period ratio, we know number of days or months divided by debtors turnover ratio. So 2 months they have given as debtors collection period is equal to 12 months divided by debtors turnover ratio, which is equal to 12 divided by 2, which is 6 times. It means the debtors will be 1 by 6 times of total credit sales. So using this we can find out our debtors. So 15 lakhs is our sales into 1 by 6. So 15 lakhs into 1 by 6, which is equal to 2,50,000. Now calculation of proprietary fund or net worth ratio. So it is stated that the fixed assets to net worth is 1:1. It means the net worth of proprietary fund is equal to fixed assets. Since fixed assets we know it is 7,50,000, so proprietary ratio also needs to be 7,50,000. So next is calculation of reserves. Reserve to share capital is 0.5:1. Capital is equal to 7,50,000 divided by 1.5:1. So total is how much? 0.5 plus 1, 1.5. So take that as your denominator into 1, which is 5 lakhs. So reserves is 7,50,000 into 0.5 divided by 1.5. We are just dividing, appropriating or proportionating it into the ratio. So we are getting 2,50,000. So now whatever amounts we have got, just fill it up in your balance sheet. So it will be capital 5 lakhs, reserves 2,50,000, current liability is 2 lakh, fixed asset is 7,50,000, current asset we have debtors 2,50,000, stock 2 lakhs, but the total current asset will come up to 5 lakhs according to the calculation that we have done. So cash is nothing but your balancing figure, which is 50,000. So the asset side balance is 12,50,000 minus your liability side. So your balancing figure long term liability is 3 lakhs. Thank you, and we are moving on to the next question. Which is the following details of Zinc Corporation are available for the year ending 31st/3/2014. The following details of Zinc Corporation are available. So we will look into all the details. So they have told us to prepare profit and loss account of the company. So in order to prepare the profit and loss account of the company, what all details do we need? So we need certain details to prepare the profit and loss account of the company. So we need details for preparing the trading account also. Only then we can prepare the profit and loss account. So in order to prepare the trading account, opening stock, purchases, sales, closing stock, all we need. So keep in mind all this one before you prepare. Okay, then whatever expenses, if you find out, if you're able to find it out, then you can add it in your profit and loss account. So with the following information, so they've given stock turnover ratio and average stock. With the help of that you can calculate your cost of goods sold. So cost of goods sold is equal to stock turnover ratio is equal to cost of goods sold divided by average stock. So 12 is equal to cost of goods sold divided by 9,000. Cost of goods sold is equal to 9,000 into 12. Cost of goods sold is equal to 1,08,000. Calculation of opening and closing stock. So given average stock, we know it is 9,000. So when in one can assume that opening stock and closing stock as equal to opening stock is 9,000 and closing stock is 9,000. How? Because average stock is 9,000. So obviously 9 plus 9 is 12, 18,000. We are just assuming it. We are not because we don't have any information, so we are just assuming it so that we can put it up in our trading and profit and loss account. Calculation of purchases. Cost of goods sold is equal to opening stock plus purchases minus closing stock. So 1,08,000 is your cost of goods sold, which is equal to 9,000 plus x minus x. Okay, which is equal to minus x is equal to 9,000 minus 1,08,000 minus 9,000. X is equal to 1,08,000. This is nothing but your purchases. So calculation of sales and gross profit. The information that is given about sales and gross profit is gross profit on sales is 40%. So net income after tax as a percentage of sales is 10%. So you can consider this information, which is gross profit on sales is 40%. So sales is equal to cost of goods sold plus gross profit. This formula can also be implemented. So given gross profit is equal to percentages, or if gross profit percentage is on sales, so 40% on cost, it would be, if sales is equal to 100, gross profit will be 40 and cost will be 60. Therefore gross profit percentage is 40 divided by 60 into 100, which is nothing but gross profit divided by cost into percentage. So 66.66%. Therefore sales is equal to 1,08,000 plus the percentage of gross profit. Okay, 1,08,000 into 66.66%, which is cost of goods sold plus gross profit. So therefore sales is equal to 1,08,000 plus 72,000. Sales is equal to 1,80,000. Calculation of net profit. So net profit after tax, they have given in the question as a percentage of sales, which is equal to 10%, so which is 18,000. So now we have all the information given, and net profit before taxes. Tax is 0.55%, given 20,000 after taxes for 0.45%. So 18,000 divided by 45%, so 45 into 100, which is equal to 40,000. So now after finding out all the information, just put up the information in your profit and loss account. So we start with the trading account. Opening stock is 9,000, closing stock is 9,000. Purchases, we have found it out to be 1,08,000. Sales is 1,80,000. So the gross profit, which is 72,000. So now by gross profit brought down 72,000. The expenses, which is nothing but our balances, because we have the net profit which we calculated, which is 40,000. So expenses is 32,000. So the total is 72,000. And by net profit 40,000. So now to net profit after tax, which is given in the question, which is 18,000. So to income tax is nothing but the balancing figure, which is 22,000, which is a 55% of 40,000 net profit. Now moving on to the next question. So next question: from the following information pertaining to Yogesh Limited, prepare its trading account and profit and loss account for the year ended. They have given the ratios and the amounts of certain stuffs. We are supposed to calculate and prepare our balance sheet. So when we get questions like this, always whatever information is given, keep the information, calculate one or the other item amounts so that we can put it up in a balance sheet, and the balance sheet needs to tally. That is what is very, very important. So gross profit ratio, we start gross profit divided by sales into 100. So gross profit they have given 7,30,000 into 10 by 100, which is equal to 73,000. Current ratio is equal to current asset divided by current liability, which is equal to 2.5 they have given. Working capital is current assets minus current liabilities. Working capital is given in the question 1,20,000. So 1,20,000 is equal to current asset minus current liabilities. So current asset is equal to 1,20,000 plus current liabilities. So putting that in the current ratio. So 2.5 is your current ratio. So current asset we consider to be 1,20,000 plus current liabilities divided by current liabilities. So cross multiply 1.5 current liability is equal to 1 lakh. How did we get this? 2.5 current liability minus 1 current liability, which is equal to 1.5 current liability is equal to 1,20,000. So current liability is equal to 80,000. Now current asset, with that we can use it as 2 lakhs. How did we get this? Current 1.5 current liability is 1,20,000. So current liability is 80,000. So current asset is how much? 1,20,000 plus current liabilities. So 1,20,000 plus 80, which is 2 lakhs. Next is quick ratio. Quick assets divided by quick liabilities. 1.3 is equal to current asset minus stock divided by current liabilities minus bank overdraft. 1.3 is equal to 2 lakhs minus stock divided by 80,000 minus 15,000. 1.3 is equal to 2 lakhs minus stock divided by 65,000. So 84,500 is equal to 2 lakhs minus stock. 84,500 minus 2 lakhs, which is equal to minus stock. 1,15,500 is nothing but your stock. Debtors velocity, they have given it to be 40 days. So debtors velocity divided by sales into 365 days, which is equal to 40. So debtors divided by 7,30,000 into 365, which is equal to 40. So debtors is equal to 80,000. Proprietary ratio, fixed assets divided by proprietary funds, which is equal to 1,80,000 divided by 3 lakhs. So in the question we have proprietary fund plus long term loan is equal to fixed assets plus working capital. So assuming the long term loan as nil, okay, we do not have any long term loan. Let the proprietary fund be x. X is equal to 0.6x plus 1,20,000. So x minus 0.6x is equal to 1,20,000. So 0.4x is equal to 1,20,000. So x is equal to 3 lakhs. Fixed asset x is equal to 3 lakhs. Fixed asset is equal to 3 lakhs into 0.6, which is nothing but your proprietary ratio. 1,80,000 divided by 3 lakhs is 0.6. So we get fixed assets to be 1,80,000. So proprietary fund is equal to fixed assets plus 1,20,000. So proprietary fund is equal to 0.6 proprietary fund plus 1,20,000. The proprietary fund is equal to, there's a quite mistake here. Proprietary fund is equal to fixed assets plus 1,20,000. Fixed assets we found it out to be 1,80,000. So 1,80,000 plus 1,20,000 is equal to 3 lakhs. Net profit is equal to 10% of proprietary fund, which is 3 lakh into 10%, which is 30,000. Closing stock is 10% more than the opening stock they have told. So closing stock is 1,50,000, which found out. So opening stock is 1,50,000 is for 110%, because closing stock is 10% more. So what is for 100%, which is your opening stock? Cross multiply 1,05,000. So closing stock is 1,15,500. So now when you put it up in your trading and profit and loss account and balance sheet, you get it up to be opening stock is 1,05,000, gross profit is 73,000, sales is 7,30,000, closing stock is 1,15,000. So balancing figure is nothing but your purchases, which we are not able to find it out in the question, which is the given for the given information. So now moving on, by loss profit, which is 70, by gross profit, which is 73,000. So operating expenses we have, which is nothing but your balancing figure. We have not found it out. Okay, net profit we found it out to be 30,000. So 43,000 is your balancing figure, which we consider to be operating expenses. Moving on to your balance sheet, we have share capital 2,50,000, reserves and surplus 50,000, bank overdraft 15, other liability 65,000. Fixed assets we have 1,80,000. Now if you see current asset total, they have given it to be 2 lakhs, which we found it out. And that stock and debtors we found out to be 1,15,500 and debtors as 80,000. The balancing figure will always be considered as cash, which is 4,500. So the total of balance sheet tallies. Moving on to the next question. So the capital of a company is as follows: 9% preference shares of rupees 10 each, 3 lakhs. Given every information, and this is a direct question wherein they have told us to calculate certain ratio. So debt equity ratio is debt outside fund and equity is the shareholders fund. So debentures they have given 10 lakhs, equity is 9% preference shares plus the equity shares. So 3 lakhs plus 8 lakhs, which is 11 lakhs. So debt equity ratio is equal to 10 lakhs divided by 11 lakhs, which is 0.91 is to 1. Capital gearing ratio, equity shareholders funds divided by fixed income bearing funds. So 8 lakhs divided by 3 plus 10, so 8 divided by 13 lakhs, so which is equal to 0.62 is to 1. Earnings per equity shares is equal to earnings available to equity shareholders divided by number of equity shares. So earnings available to equity shareholders is equal to profit after tax minus preference dividend, which is equal to 2,70,000 minus 27,000, which is 2,43,000. So 2,43,000 divided by 80,000, the number of shares, which is equal to 3.04. So price earning ratio is market price per share divided by earnings per share, which is equal to 40 divided by 3.04 is our EPS, which we found out. So it is 13.16 times. Next question, the ratio relating to Cosmos Limited are given as follows. Gross profit ratio is 15%, stock velocity is 6 months, debtors velocity is 3 months, creditors velocity is 3 months. Gross profit for the year ending 31/12/2016 amounts to 60,000. Closing stock is equal to opening stock, they have told, and they have told us to calculate sales, debtors, closing stock and creditors. So calculation of sales, it can be computed through gross profit percentage. So given gross profit is rupees 60,000, which is equal to 15%. So sales is equal to 60,000 divided by 15 into 100. So 60,000 is for 15%. So what is for 100%? Cross multiply. That's how you get 60,000 divided by 15 into 100, which is 4 lakhs. So calculation of closing stock, it can be computed through stock turnover ratio only, always, because only in that ratio we have the average stock. So stock turnover ratio is equal to cost of goods sold divided by average stock. Therefore 12 by 6, which is equal to 4 lakh minus 60,000. Okay, 4 lakh. How did you get this 4 lakh? Sales minus gross profit divided by average stock. So stock turnover ratio is 6 months, which means 2 times in a year. It can be written as 12 by 6. That's how you got 12 by 6. So average stock is 3,40,000 divided by 2, which is equal to 1,70,000. So since it is specified that closing stock is equal to the opening stock in the question, so closing stock is 1,70,000 divided by 2. How did we get this 1,70,000? Is nothing but average stock. Average stock divided by 2, because opening and closing. So 2, so 85,000, both are remaining equal. That's how it is told in the question. So calculation of debtors. Given debtors velocity is 3 months, which means 4 times in a year, so 12 divided by 3. Okay, average debtors turnover ratio is net annual credit sales divided by average trade debtors. So 4 is equal to 4 lakh divided by average trade debtors. So debtors is equal to 4 lakh divided by 4, which is equal to 1 lakh. So calculation of creditors, given creditors velocity is 3 months, that is 4 times in a year, 12 divided by 3. Creditors turnover ratio is net annual credit purchases divided by average trade creditors. First we have to calculate the value of credit purchases, only then we can go ahead. So purchase is equal to opening stock plus gross profit minus sales plus closing stock. So purchase is equal to 85,000 plus 60,000 minus 4 lakh plus 85,000. So purchase we get it as 3 lakh 40,000. So creditors turnover ratio is 3 lakh 40,000 divided by average trade creditors, which we don't know. So 4 is equal to 3 lakh 40,000 divided by average trade creditors. Average trade creditors is equal to 3 lakh 40,000 divided by 4, it is 85,000. Next question, given the following particulars: debtors velocity, creditors velocity, stock velocity, fixed assets turnover ratio, gross profit turnover ratio, and gross profit during the year amounted to 80,000. There is no long term loans overdraft, they are telling. Long term loans and reserves and surplus amounted to rupees 28,000. Liquid assets are 97,333. Closing stock is 2,000 more than the opening stock. Bills receivable, bills payable, they are tolling it as 5,000 and 2,000 respectively. So you're supposed to find out sales, sundry debtors, closing stock, sundry creditors, fixed assets, proprietors fund, and also you're supposed to make out the balance sheet. Sales gross profit ratio is 25%, so gross profit is 80,000. So gross profit ratio is, say, gross profit divided by sales into 100. So 25 is equal to 80,000 divided by sales into 100. Sales is 80,000 divided by 25 into 100. Sales is 3,20,000. Sundry debtors, average debt collection period 3 months. So debtors turnover ratio, they have given it 4 times, so 12 by 3, which is 4 times you can consider. So debtors turnover ratio is equal to net credit sales divided by average trade debtors. 4 is equal to 3,20,000 divided by average debtors. Average debtors is equal to cross multiply 3,20,000 divided by 4, which is 80,000. So closing stock, purchases or cost of goods sold plus closing stock minus opening stock. So cost of goods sold is 75%, which is 100 minus 25%. So 75 divided by 100 into sales. 75 divided by 100 into 3,20,000. So cost of goods sold is 2,40,000. Purchases, cost of goods sold plus closing stock minus opening stock, 2,40,000 plus 2,000. As closing stock is rupees 2,000 more than the opening stock. So purchases is 2,40,000. Because we know the balance is 2,000, we consider directly 2,000. So purchases is 2,42,000. Calculation of stock, stock turnover ratio is equal to our cost of goods sold divided by average stock. 8 is equal to 2,40,000 divided by average stock. Cross multiply, average stock is equal to 2,40,000 divided by 8. Average stock is equal to 30,000. Average stock, we know it is 30,000. With that help we can use or calculate opening and closing stock. So opening plus closing stock divided by 2, 30,000 is equal to opening stock plus 2,000 divided by 2. 30,000 is equal to 2 opening stock plus 2,000 divided by 2. Why we consider both as opening stock is closing stock is nothing but opening stock plus 2,000. So opening stock is 29,000 if we cross multiply. Closing stock is opening stock plus 2,000, which is 29 plus 2,000, 31,000. So sundry creditors, creditors turnover or creditors velocity ratio is equal to total creditors divided by credit purchases number of months. So 2 is equal to total creditors divided by credit purchases is equal to number of months. 2 is equal to total creditors divided by 2,42,000 into 2. Total creditors, we get it up to 40,333. Fixed assets, we have fixed assets turnover ratio given. So net sales divided by fixed assets, 8 is equal to 3,20,000 divided by fixed assets. Cross multiply, you get your fixed assets to be 40,000. So last but not the least, Proprietors fund is equal to fixed assets plus working capital is equal to current assets minus current liabilities. So current asset is equal to liquid asset plus stock. We have liquid asset given and we have the stock, so total we get the current assets. Current liabilities, creditors plus bills payable, we get the total current liabilities. Working capital 86,000, the current assets minus current liabilities. Now fixed asset is equal to 40,000, proprietors fund is equal to 1,26,000. So put that everything in your balance sheet, you get capital which is 98,000, which is 1,26,000 minus 28,000. Reserves, and which 1,26,000 is your proprietors fund minus 28,000. What is this 28,000? Is nothing but reserves and surplus is 28,000. So proprietors fund will always include capital and reserves and surplus. So we minus it and we get 98,000 as capital, reserves and surplus 28,000. Creditors we have, bills payable we have, fixed assets, stock, debtors, cash and bills receivable. You get your total of your balance sheet get tallied. Cash is nothing but your balancing figure, which is 12,333. The following trading profit and loss account, they have given everything, and we are supposed to calculate gross profit ratio, operating net profit ratio, expenses ratio, net profit ratio, stock turnover ratio. So calculation of gross profit ratio. Gross profit ratio is equal to gross profit divided by sales into 100. 2 lakhs divided by 5 lakhs into 100, which you get 40%. Calculation of expenses ratio. Expenses ratio, how you calculate it? Each expense you take and divided by sales. So administrative expenses ratio is equal to administrative expenses divided by sales into 100 is a formula. So 1,01,000 divided by 5 lakhs into 100. So administrative expenses divided by sales into 100. Selling and distribution expenses divided by sales into 100, which is 12,000 divided by 5 lakhs into 100, which is 2.4%. Calculation of operating ratio. Operating ratio is equal to operating cost divided by net sales into 100. Operating cost is equal to cost of goods sold plus administrative expenses plus selling and distribution expenses plus financial expenses. 5 lakhs minus 2 lakhs plus 1,01,000 plus 12,000 plus 7,000, which you get 4,20,000. Operating ratio. 4,20,000 divided by 5 lakhs into 100, which is 84%. Calculation of net profit ratio, which is net profit divided by net sales into 100. 84,000 divided by 5 lakh into 100, which is 16.8%. So operating profit ratio, which is operating profit divided by net sales into 100. So operating profit is nothing but net sales minus operating cost, which is 5 lakh minus 4,20,000. 80,000. Operating profit ratio is equal to 80,000 divided by 5 lakh into 100, which is 16%. Calculation of stock turnover ratio. Stock turnover ratio is equal to cost of goods sold divided by average stock. So 5 lakh minus 2,000, the cost of goods sold, divided by average stock is opening stock plus closing stock divided by 2. So 76,250 plus 98,500, which you get the stock turnover ratio to be 3.43 times. Thank you everyone.